So if you happen to look at your portfolio this morning and you saw a crater where Peloton used to be, you are definitely not alone.
Yeah, not at all.
The stock PTON, it has just, absolutely capitulated. We are talking a drop of over 25% in one day.
It was brutal. Absolutely brutal. The stock closed around $4.39, which is an 18-month low.
Wow.
And the volume was just intense. Over 51 million shares traded. That's what, 4 times the average? Investors were running for the exits.
Welcome to Talk Tickers. This is the deep dive where we try to, ignore the panic and actually look at the numbers to find the signal and all that noise.
Yep.
Today, we are dissecting Peloton's fiscal year 2026 Q2 earnings. And honestly, reading through it, it feels like that classic saying, the operation was a success, but the patient is shrinking.
That is the perfect way to frame it. You look at the bottom line and they are leaner, they're more profitable, they're generating cash. But then you look at the top line, the actual revenue, and it's vanishing. And the market is terrified that this whole thing is just a melting ice cube.
So that's our mission. We need to unpack why a company that just raised its profit guidance, which should be good news,
Should be great news.
is seeing its market cap just decimated. We're going to look at the numbers, the departure of their CFO, and this really interesting problem they're having with their own products.
It's a fascinating paradox. Let's start with the snapshot.
Okay, let's get the bad news out of the way first, the misses. They were significant.
Yeah, they were.
Revenue came in at $656.5 million. The street was looking for over $674. That's down 3% year over year.
And the earnings per share, the EPS, that was a loss of 9 cents. Analysts were looking for a loss of only 6 cents.
So they lost more money per share than predicted.
And brought in less revenue. In a market this fragile, that is a recipe for disaster.
And this is where it gets so confusing if you're just looking at the stock price, the internal metrics look incredible.
They really do. That operation was a success part you mentioned. Their total gross margin hit 50.5%.
50.5.
That is up 320 basis points year over year. For a business that sells hardware to clear 50% gross margins, that's impressive.
Can we just pause on that for a second? For anyone who doesn't live in a spreadsheet, can you explain what basis points are and why that 50% number is such a big deal?
Sure. A basis point is just 1/100%. So 320 basis points is a 3.2% jump.
Okay.
And that might sound small, but in manufacturing, that's a massive gain in efficiency. It means for every dollar Peloton brings in, they're keeping 50.5 cents after the cost of goods.
Right.
Usually hardware companies have really low margins because making physical stuff is expensive. Peloton hitting 50% means they're starting to look more like a software company on their balance sheet.
Which is the goal. And their adjusted EBITDA. That's basically their operational profit, right?
Exactly. It's earnings before interest, taxes, depreciation, and amortization. It's a clean look at the raw operating performance.
And that was $81.4 million, up 39% from last year. And they generated $71 million in free cash flow.
Exactly. The core business works. They're paying down debt too. Net debt is down 52%. They're running a very, very tight ship.
The problem is, like you said, the ship is just taking on less cargo. It's this collision between the margin story, which is great, and the demand story, which is, falling apart.
And that collision is happening right at the point of sale.
So let's dig into that demand story. Why the big revenue miss? Because reading the call, CEO Peter Stern was pretty candid about it. It wasn't about finding new people.
Yeah.
It's that the people they already have didn't want the new stuff.
This is what we're calling the durable curse. The main reason for the miss was just weaker than expected sales of their new cross-training series hardware to existing members.
To their own people.
Exactly. Management admitted it. They just overestimated the upgrade cycle.
It's so ironic. We usually complain when products break too fast. Here, the problem is that the original Peloton bike is built like a tank. It's just too durable.
Yep. People love their old bikes. They're still riding them. So when Peloton comes out with this fancy new hardware, the existing user just says, my bike works fine. Why would I spend thousands to replace it?
It's the innovator's dilemma in real time.
Yeah.
You build something so good, it cannibalizes your future sales.
And management was very clear on this. New member acquisition. Roughly in line with what they expected. The brand is still attracting people. But that super fan upgrade cycle they were banking on, it just didn't happen.
It reminds me of that problem Apple had with the iPad for a while. The old ones just refused to die, so nobody bought new ones.
It's the same thing. And unlike an iPad, you can't just slow down the software on a stationary bike to force an upgrade.
Hey.
If the pedals turn, the user is happy. And frankly, in this economy, telling someone to spend $2 or $3 grand to replace something that works perfectly, that's a tough sell.
I saw a note about delivery delays pushing some revenue into the next quarter. Was that a big deal?
It was about $4 million. Some friction with deliveries and activation timing. But honestly, in a $650 million quarter, $4 million is a rounding error.
Yeah, that's not it.
You can't blame a 26% stock drop on a $4 million timing issue. This is structural. It's about demand.
Okay, but let's talk about the people who are staying, because for all the doom and gloom, the subscriber numbers tell a slightly different story.
They do. So ending paid connected fitness subs were 2.661 million. That is down 7% year over year, so the base is shrinking.
Yeah.
But the churn rate was 1.9%.
1.9%. That seems incredibly low for any consumer subscription, especially since they just raised prices.
It's a huge resilience statistic. That's what stands out.
Yeah.
Churn is just the percentage of subscribers who cancel. A churn of 1.9% means over 98% of their paying members decided to stay on.
Even with a price hike.
Even with the price hike. The churn was lower than they feared. It shows that the people inside that ecosystem are sticky. They're loyal. So the user base is eroding, but it's a slow leak, not a burst dam.
So they have pricing power over their core audience. They can charge them more and they'll pay it. But they can't get those same people to buy a second piece of expensive hardware.
That is the wall they've hit. They've maxed out the value from the subscription, but the hardware side is hitting a ceiling.
So if the users aren't upgrading, Peloton knows this. They're trying to pivot the whole value proposition. There was a lot of talk on the call about wellness and AI.
Right. This is the shift from, lifespan to health span. Peter Stern mentioned this a lot. They want to be a holistic wellness platform, not just a bike company. And the centerpiece of that is Peloton IQ, their AI coaching.
The engagement on that was actually pretty good. Something like 46% of active members used the performance insights.
And the media loves it. The Wall Street Journal, The Verge, they've ranked Peloton's AI features above Apple and Google in some cases.
Oh.
So this isn't just marketing fluff. They are building real utility that analyzes your workout and gives you specific feedback.
But here's the disconnect, and I think this is why the market is punishing them so hard. Great tech and high engagement, that doesn't pay the bills if it doesn't translate to hardware sales.
Precisely. The whole story they tried to sell was an expensive hardware refresh driven by these new AI features. But in this soft consumer economy, with confidence at an 11-year low, people aren't spending $3 grand for better AI coaching on a bike.
It's a nice to have, not a must have.
Not for that price.
Yeah.
The AI doesn't justify a multi-$1,000 purchase when the old bike still works.
It's like they've built a Ferrari engine and are trying to sell it to people who are perfectly happy with their Honda Civic.
Or who already own the Honda Civic and don't see the need to trade it in. It still gets them from A to B.
Okay, we have to talk about the other shoe that dropped. The news that probably spooked the big investors just as much as the revenue miss. The C-suite shakeup.
Yeah. The CFO, Liz Coddington, is leaving. She's staying through March, but she's heading to a private clean tech energy company.
A CFO leaving in the middle of a big turnaround, that always sends up red flags, doesn't it? Even if they say it's for a new opportunity.
It does. I mean, even if it's completely amicable, which it seems to be.
Yeah.
Liz Coddington was the architect of this financial discipline we were just praising.
She's the reason margins are up.
And debt is down. Losing her adds significant execution risk right when they're in this delicate spot.
It's like the pilot ejecting just as the plane is trying to land in a storm. Maybe the plane still lands, but everyone on board gets a lot more nervous.
And she's the one with the relationships with the banks, the lenders. All that institutional memory is walking out the door. The market hates uncertainty, and losing the person holding the purse strings creates a ton of it.
And on that note, they're still cutting costs. Another 11% workforce reduction.
Cutting right down to the bone. But there was one little green shoot in the update we shouldn't overlook, the commercial revenue.
That's the pre-core business. Hotels, corporate gyms, that kind of thing.
Exactly. Commercial revenue grew 10% year over year. They're shifting maintenance and heavy use support over to pre-core.
Smart.
It's a smart move. They're realizing that while the home market is saturated, the out-of-home market, getting Peloton bikes into every Hilton and Hyatt, that's still growing.
And it's a marketing channel, too. You try it at the hotel, maybe you subscribe to the app when you get home.
That's the theory. But for now, it's one of the few lines on the spreadsheet that has a plus sign next to it for growth. It shows the brand still has cachet, even if the home consumer is tapped out.
So, shrinking home business, growing commercial business, and a CFO on her way out. Let's look at what they told us about the future. The guidance.
This was the guidance shock. This is what really cratered the stock pre-market. For Q3, they're guiding revenue of $605 to $625 million. The street was expecting $638.
That is a big gap.
It is. And for the full year, FY26, they lowered revenue guidance down to 2.4 to 2.4 billion. That's down 3% year over year. They're basically screaming, the growth isn't coming back this year.
But here's the paradox again. They lowered revenue guidance, but they raised profit guidance.
Correct. They raised the full year adjusted EBITDA guidance up to between $450 and $500 million.
Yeah.
And they raised the free cash flow target to at least $275 million.
This is what's so fascinating. If you're a value investor, you see a company generating almost $300 million in cash, trading at $4, and you think buy.
Right.
But if you're a growth investor, you see shrinking revenue and you run for the hills.
And right now, fear is winning. Investors are looking at the macro picture. Consumer confidence is low. You have competition everywhere. You have this whole shift with GLP-1s, with Ozempic, that changes how people think about exercise.
I want to double click on that, the Ozempic effect. Is that a real headwind?
It's complicated. I mean, some data suggest people on these drugs actually exercise more to maintain muscle mass. That's why Peloton is pushing strength training so hard. But other investors worry that if you can lose weight with a shot, the motivation to sweat on a bike for an hour just drops. Peloton is betting they can pivot to be the muscle maintenance platform for the Ozempic generation.
It's a smart pivot, but it's unproven. And the verdict from the market today was just crystal clear. They punished the growth concern way, way more than they rewarded the profitability.
Oh, they did. A 26% drop says investors are terrified. This is the melting ice cube. It doesn't matter how profitable you are today if your revenue base is disappearing tomorrow.
Okay, so we have a company that is profitable, cash flow positive, loved by its core users, but absolutely hated by the stock market. This feels like the perfect setup for our favorite segment.
Yeah, I have a feeling I know where this is going.
It is time for This Is Not Financial Advice.
All right, disclaimer time. We are not financial advisors. Do not do anything we say. This is purely for entertainment.
Okay, here's the pitch. I'm calling this the sweaty takeover arbitrage.
I'm listening.
Look at the board. Peloton is at an 18-month low. It's a $4 stock. The market cap is a fraction of what it was. But they just proved they can generate $275 million in free cash flow.
That is real money. Cold, hard cash.
And they have 2.6 million high-income, extremely loyal subscribers who barely ever churn. The hardware business is a mess, sure, but the data and subscription business, that's a gold mine.
It's a recurring revenue machine shackled to a hardware anchor.
Exactly. So here's the trade. You go long PTON and you short the gym chains.
Okay, explain the logic.
You buy Peloton not for the turnaround story, but as a buyout target. At this valuation, they are a snack for a tech giant. Think Apple or Amazon.
Right.
They don't care about the byte hardware profit. They buy it for the 2.6 million affluent users and all that health data.
They could shut down the expensive manufacturing, license the hardware completely to Precor, which is kind of happening anyway, and just keep the high margin app. That solves the capital problem overnight.
Precisely. Or, here's the outrageous twist, a health insurance company buys them.
Ooh, interesting.
Peter Stern kept talking about HealthSpan. Imagine an insurer buying Peloton to integrate the Peloton IQ data right into premiums. You ride your bike, your insurance goes down. They incentivize preventive health.
That actually aligns perfectly with the narrative.
Yeah.
You monetize the data, not the bike. It turns the durable curse into a benefit. If the bike lasts forever, the data stream lasts forever. It becomes a health monitor in your living room, paid for by your insurer.
It's a casino bet on a distressed asset. I get that. But at $4, with that much cash flow, it feels like the company is worth more dead than alive to the public markets, which means someone might just take it private.
It's definitely a plausible, wild scenario. The sum of the parts might be greater than the whole right now. And frankly, with a market cap this low, a private equity firm could buy it using its own cash flow to pay off the debt. It's a classic LBO candidate.
All right, let's wrap this up. We've covered a lot.
Yeah, to recap, Peloton is leaner, more profitable, generating significant cash. The cost cutting has absolutely worked.
Nobody is buying the new bikes. The existing members are holding on to their old ones because they're just too good, and the CFO is walking out the door.
The company is successfully pivoting its product to wellness and AI, and the users who engage with it seem to love it. But the financial markets are screaming that they don't believe the company can survive the revenue drop long enough for that pivot to actually pay off.
It's a race against time. Can they stabilize the top line before the market just completely loses faith? Judging by that 26% haircut today, the clock is ticking very loudly.
It certainly is.
That's all we have for this deep dive. Thanks for listening to Talk Tickers. Keep your eyes on the tape.